So first, we will have keynote presentation and special presentations and a panel discussion. And we are now going to present to you the keynote presentation of the day. Founding Director of UK Centre for Green Financing and Investment and Professor of Oxford Sustainable Financial Program at the University of Oxford, Professor Ben Caldecott will join us through video. Thank you.
Hello, thank you so much for that very kind introduction. It's wonderful to join you for the 10th Seoul Asian Financial Forum. It would have been delightful to be in Seoul, and I'm sorry to be joining you virtually, but hopefully you can see me and hear me loud and clear. I'm going to be speaking a bit about sustainable finance, the drivers and future directions in this very exciting and important area of financial services. So what I wanted to do is quickly talk about the scale of the opportunity. I then wanted to talk a bit about risk and materiality and associated changes in supervision. Those are very important for many of the people, I think, in the audience. I also wanted to talk about impact and trying to make a difference through sustainable finance and investment, which is, of course, a large part of what all of this is about. And then I wanted to share with you some thoughts about the future direction of sustainable finance, in particular, transition finance and also spatial finance. And both of these, I think, are very exciting for the future of financial services more generally, actually, but a core part of sustainability and sustainable finance. So what are the drivers? So the first driver, the first bucket, if you will, is opportunity. And in part, this is about scale, quantum, the sheer amount of capital required to transition. So this slide shows you a study from Nature, the journal Nature, estimating the amount of investment required, additional investment required per year to achieve different climate targets. And you can see here, up to 2050, to achieve the Paris Agreement, which is to stay within 1.5 degrees, they estimate that globally we will need over 1.5 trillion US dollars each year above and beyond what we currently invest in the energy system to achieve 1.5 degree target. That number falls to about $1 trillion if we target 2 degrees. And then they estimated the nationally determined contributions, the promises that were made just after the Paris Agreement was negotiated. So this is around 2016, the nationally determined contributions. And as you can see, that number is lower. And that's because the level of ambition in nationally determined contributions then was much lower than it is today. So what's happened, partly progress in Korea, of course, but also in Japan, China, the United States, Europe. Nearly 90% of the global economy has some kind of net zero target now. So the NDCs are getting closer to the 2 degree, 1.5 degree level. And this implies a huge amount of investment. And it's not just the energy sector. So if you think about it, it is heavy industry, it is transport, it is anything to do with infrastructure, it is agriculture. All of these sectors, it's subsectors that are massive, like the automobile industry. It's shipping. Name your sector. There's a massive capex requirement, and that's in part because we're moving from an economic system based on OPEX, based on operational expenditure, to one based on capital expenditure. To take an example, if you're building a wind farm or solar park, most of the cost is up front. After you've built the plant, the facility, the wind and blows for free, the sun shines for free, the marginal cost is very low. In contrast to if you build a gas-fired power station or a coal-fired power station, where most of the lifetime cost is actually in the fuel that you're burning, combusting in that facility. That's the proposal. So it's an OPEX model. We're moving to a CAPEX model, an upfront cost model, across all of these sectors. And that means there's a huge demand for capital, and that means there's going to be a huge demand for financial services firms that can deploy capital and help people organize capital. And we're seeing this already, of course, as well. We're at the beginning of this transition that's rapidly accelerating, but these are numbers from Bloomberg New Energy Finance, tracking investment, global investment in the energy transition by sector. And you can see for more than a decade, we've been seeing investment above the $200 billion mark. And over the last few years, we've seen a very significant growth in investment in electrified transport. Obviously, these numbers are not sufficient to get us to 1.5 degrees, let alone 2 degrees, but they show what's possible, very rapid growth in a relatively short period of time. And these are now mainstream sectors that are absorbing a huge amount of investment. So the size of the requirements is really exciting for financial institutions. Another aspect of this, and this is driving a lot of inflows into sustainability funds and ESG funds, is this relationship between ESG performance and financial performance. And there are a number of studies that look at this, and this is one of a number of meta-studies. This meta-study basically looked at all these different bits of the literature, different academic papers, looking at the relationship between ESG performance and financial performance, and they found that there's a positive relationship. 58% of the corporate studies focused on return on equity or the stock price, for example. Investment studies also showed strong correlation with outperformance. And there's also a duration effect here. So the positive effects can happen over the longer term. This is another finding from this meta study. There are any number of reports one can point to looking at this evidence base. I think the theoretical underpinnings of this are robust, that companies that adopt ESG practices, all things being equal, are going to be more efficient. They're going to deal with reputational risks more effectively. If they're more efficient, more productive, that's going to improve their profitability, their stock price. It's going to make them less risky. That's going to reduce their cost of debt, cost of equity. And so this is another reason why this is important. So in addition to the quantum, the amount of investment that's required, there's a performance aspect to this too. So that's the opportunity side of things. Risk is another massive driver. So in every future state, there is some combination of climate-related risk. And this chart shows you can have scenarios where we tackle climate change rapidly. And we do that through policy and regulation. We do that through technological innovation. We do that through changing social norms, changing consumer preferences. That creates transition risk. And as a result, we have less future climate impacts. We have fewer storms, fewer floods, fewer wildfires as a result of as a result of increasing the pace of the transition. Or we have scenarios where we don't act, and as a result, we have more climate change, more of those events that I talked about before, those climate events, weather-related events. And as a result, we have less transition risk. So every future state has some combination of risk. Unfortunately, we could also have futures where we have a lot of both. We have a lot of physical risk and we have a lot of transition risk. I actually think that's probably where you should be planning to be, and where we should all be planning to be, because that's what a prudent risk manager would do. But also, there's good reason to believe that we'll have a lot of both. Personally, I don't believe that transition risk can be put back in its bottle. A lot of the drivers that are disrupting sectors of the global economy would continue, even if we woke up tomorrow and we all suddenly believed that climate change wasn't happening. It wasn't a problem. Would the deployment of electric vehicles, would the transformation of the automobile industry stop if we thought climate change didn't exist? No, it would continue. It might continue a bit more slowly, but it would still disrupt that whole industry. And similarly with renewable power, it's already cost-effective, cost-competitive in most parts of the world already. Is that going to stop? Are we going to stop building wind farms, solar parks as a result of this, when it's the most cost-effective thing to build in many places around the world? No, we're going to continue doing that. That's going to continue to disrupt markets. And also, we're likely to have quite a lot of physical risk in the future. we have a lot of warming already built into the system. So the Paris Agreement is targeting 1.5 degrees above pre-industrial levels. We're currently at about 1.13, 1.14 degrees above pre-industrial levels. So there's not a long way to go before we reach 1.5 degrees. And even if we stopped emissions globally tomorrow, which again is impossible, but if we did, we would still have a lot of climate change baked into the system. We would still be having to deal with, we would still be having to adapt to physical climate change impacts. And of course, there's always the threat that the risk, the chance that the scientists have got it wrong, that there's runaway climate change, there are tipping points, that actually the models have been too conservative and we have more climate change than we thought. So it's quite possible that we have a lot of both of these things in the future. And it's not just climate risk, it's also other forms of environmental risk. And I've alluded to some of these already. It's technological change, it's policy and regulation. More policies are getting introduced to deal with environmental issues. Where they get introduced, they become more stringent. We have climate change already happening. We've got biodiversity loss. Consumer preferences are changing all the time, rapidly. Whether it's vegan January or the fossil fuel divestment campaign or whatever it might, alternative proteins. Consumer preferences can change very quickly. Just look at, for example, plastic straws in some jurisdictions went from being absolutely fine to being completely socially unacceptable very, very quickly. Of course, there are massive differences between different parts of the world, but social norms do play a really important part of shaping markets, shaping demand. Litigation liability, increasingly important there. Hundreds of court cases now actually around the world testing the law on whether companies have misreported their climate risk exposure, mismanaged their climate risk exposure, caused climate change in the first place. There are a number of different legal routes that are being explored in courts around the world in different jurisdictions. And how courts interpret these things and how they judge, how judgments are made depends on social norms. Judiciary is a mirror image, in a sense, of society. So as society's views on things change, the judiciary's views will change. Society's views on these things will change as climate change takes effect, as regulations change, as costs change. And so one of the very interesting things for me and for my colleagues at Oxford and for other researchers is, how do these risks interact with one another in different sectors? How do you price them? Can you price them? And it's really difficult because these things are interrelated. There's a lack of a track record. They're new. They exhibit tendencies to be nonlinear, tipping points. But the key thing is that you can look at different sectors, and I've already mentioned a few, like the automobile industry and the power sector, where they're already having a massive impact. Trillions of dollars of value has been affected because of some combination of these risks. And they're not far off, distant thing. They're a current, urgent thing to deal with today. And these risks percolate up through the system. Risks affect assets, physical assets, intangibles as well in different ways. Companies operate assets. Asset managers and banks lend to companies and assets or invest in companies and assets. Asset owners, pension funds, sovereign wealth funds, insurers, central banks now increasingly as well, of course, are investing directly in assets or in companies or allocating capital to asset managers through asset managers or directly they in the banking system as well. And you then have governments, policymakers, and governments who are interested in growth, stability, resilience, meeting the Paris Agreement. So these risks that I've described, they start at the asset level and then percolate up through the system and affect everyone. And that's one of the reasons why they matter. Now, I've talked a bit about transition risk and these other risks that are driving change. Now, is there evidence of this being priced? Are these things having an impact today? We did some research at Oxford, it was published last month, looking at loan spreads. So this actually looked at all the different subsectors of the power system. We looked at energy, we looked at production, we looked at generation, we looked midstream, we looked across all the key markets to track how loan spreads have changed over the last 20 years for these different technologies across different markets, using data from LPC Deal Scan, 14,000 or so loans around the world. And there are significant regional variations, but so this chart shows you the global results. But if you take a step back and look globally, essentially what we find is that if we compare the 3 years 2007 to 2010 with the 3 years 2017 to 2020, the data goes up to December of last year. We find that the cost of capital loan spreads have increased significantly for coal mining and for coal-fired power stations. And the loan spreads for renewables have declined significantly as well. We find that loan spreads for oil and gas haven't shifted as much as you might expect. And the reason we think for this, it's not the only reason, but it's, I think, a big reason, and we're going to be doing further research on this, is that, there are lots of policies that are affecting coal mining and coal-fired power generation. There's carbon pricing. There are all sorts of regulations that are being introduced, and moratoria on mining and coal phase-out policies and emission performance standards and so on and so forth, that create risk for coal investments, for coal lending. And conversely, we're seeing in renewables, scale deployment, particularly over the last decade, driving down cost. Financial institutions becoming much more au fait, much more familiar with these technologies, and obviously they're maturing, so they're becoming less risky. And there are more providers of capital trying to provide capital for them, and therefore more competition that might be putting downward pressure on loan spreads as well. So this is a data point. The report's available on the Oxford website. Have a look, see if it conforms to what you're seeing. We'd love to speak to you about these findings. But the key thing is that these risks are starting to be priced in certain parts of the global economy, and that's going to accelerate. Now, what's happened around the world is that supervisors, central banks have started to accept that these risks are in their mandate, and that's because they could affect firm solvency. They could affect the solvency of financial firms that they supervise, as well as generate potential financial stability implications. And what they're doing is accepting that and then coming up with proposals as to how to change what they do, and then they're going about implementing that. And it started with the Bank of England, and myself and others in 2011, 2012 wrote to the then governor of the Bank of England, Sir Mervyn King, going, look, you should consider climate change as part of the mandate of something called the Financial Policy Committee, which was being established at the time, set up to horizon scan for financial stability risks. And we said, look, climate change, transition risks in particular, these aren't priced by financial institutions. The amount of value exposed to these risks is significant. If there was a repricing, it could happen in a disorderly way, in our view. And the then governor wrote back and said, thank you very much for your kind note, but we don't agree that these are mispriced, or that a mispricing or pricing correction would result in financial stability implications. Thank you very much. But a number of things happened after then, including a new governor of the Bank of England, Mark Carney. There was a formal request from the UK government to the bank to think about climate risk. And they produced a report that I was actually a co-author of that came out in September 2015. Most of that work starting in late 2014, continuing over 2015. Focused on insurance initially, but looking at exactly this question, should this be in our mandate? And the answer was yes. There was subsequent work on banks, and then changes to supervision were proposed in 2018, came into force in 2019, and they're being implemented now. And these supervisory expectations are hugely important because they place significant requirements on supervised firms. They force those firms to have a senior manager identified as the person responsible for climate risk in the firm. They require board senior management to have decision-relevant information to manage these risks, amongst a whole bunch of other things. And it means profound changes to how banks measure these risks, manage them, integrate them into what they do. And there are a whole bunch of other things happening subsequently as well, including climate stress tests and other supervisory interventions. And this journey that's taken the Bank of England 5 or so years is being replicated by others and happening much more quickly. the benefits of following on, I suppose. But you've got the Monetary Authority of Singapore has adopted similar supervisory expectations. The European Banking Authority, the Australian Prudential Regulatory Authority, FINMA in Switzerland, for example, and I think these are very significant developments. Climate stress tests too will introduce will reveal actually the exposures that supervised firms have and help to inform interventions, both microprudential interventions and macroprudential ones. And one of the other big changes that's been happening is that international financial regulators like IFRS, IOSCO, BIS have started to set up task force committees that are setting up work plans for them to do things in this space. Historically, it's been limited to more of the sustainability focused organizations, and that's changing. It's not just in the remit now of sustainability focused organizations like the CDSB or SASB, and there's mergers going on between these entities as well. SASB and the Integrated Reporting Council are merging, for example. The fact that the big players, the mainstream players, IOSCO, you don't get more mainstream than the IFRS or IOSCO or BIS, and taking this seriously means that this is being mainstreamed across the system, and finance professions have a really important role to play in doing this. These are finance professions that have committed to integrate sustainable finance into their core curriculums, into their continued professional development opportunities, to make sure that if you're a member of one of these finance professions, and remember there are millions of members of finance professions around the world, accountants, chartered financial analysts, actuaries, and so on and so on, that's going to result in change across the system. Another really important driver of change is wanting to make a difference, and I could talk a lot about this. I wanted to share with you some data points. Demand from retail investors is growing. This is from Morgan Stanley, looking at doing a sample of the general population and a subsample of younger people, millennials, to see if they're interested in sustainable investing, how that's changed over time. And you can see there's already very significant interest. There's growing adoption. That's particularly happening quickly for millennials and younger generations. So the generational shift underway. This is from institutional investors, presumably reflecting interest from their beneficiaries and from their clients. And you have 92% of institutional investors surveyed saying that they agree or strongly agree that over the long term, ESG issues will have real and quantifiable impacts. 89% agree or strongly agree that generating sustainable returns over the long term requires a sharper focus, particularly on environmental and social factors. This was 2017. The numbers will have increased by now. This is looking at CFA Institute members, chartered financial analysts, whether they look at ESG factors. This is the most up-to-date survey I could find. The numbers will be higher now. You can see that that's increasing over time. And then you have, for example, COP26 in Glasgow in November, which this the international process, the UN process, creating these moments to ratchet ambition from non-state actors, including private financial institutions. So one of the big things that was announced last month is the Glasgow Financial Alliance for Net Zero, GFANZ, which is all about, as part of Race to Zero, is all about trying to get ambitious, robust, meaningful, accountable net zero commitments from financial institutions around the world. There's still a long way to go in terms of increasing the number of commitments, ensuring that those commitments are genuine commitments, that they're actually going to mean something. But the huge amount of interest and the size of the commitment, 70 trillion of assets, made commitments last month as part of the Glasgow Financial Alliance for Net Zero, shows that this COP will be different than other COPs in the scale of financial sector involvement, and that's hugely important. Now, opportunities, and I just wanted to touch on two sets of opportunities. The first is transition finance. So I define transition finance as the provision and use of financial products and services to support counterparties, such as companies, sovereigns, individuals, to realize alignment with environmental and social sustainability. And there are a number of ways, of course, that financial institutions can provide transition finance, can help their clients transition to net zero, can help their clients become more environmentally sustainable and socially sustainable. One of the key things, one of the key products that I think is going to be a massive part of this, a really important agenda, is sustainability-linked finance. And this is sort of where, the essentially creates a really strong real economy signal. And I think this is going to grow rapidly, sustainability-linked bonds, sustainability-linked loans. And the magic happened when you find you're essentially going, look, we're going to change your interest rate or the coupon on a bond if you meet a sustainability KPI. And that KPI has to reduce credit risk, and it also has to improve environmental sustainability. So if you can find KPIs that do these two things, you can then create a structure and you can incentivize counterparties to do something that makes them less risky, but also improves the environmental outcomes. So a simple example of this would be, okay, I'm going to reduce the interest rate on your loan if you reduce your energy use by X% next year and the following year. And why does that create this benefit? Well, reducing energy use, say it's an energy-intensive company, will reduce the counterparty's credit risk because it's a large part of their expenditure. If they reduce their energy use, they're going to become more productive, more efficient. They're going to be a safer bet. That reduces their credit risk. And you can pick that up in your credit risk models. And you can share some of that reduction in credit risk with them to incentivize them to do it. And of course, reducing energy consumption in many countries, of course, given the nature of power grids and the use of fossil fuels, has a positive impact on the environment. So that's just a simple example. There are going to be lots of other examples, but we've got to find these win-wins. And we've got to ensure that those win-wins get embedded in financial structures and products quickly, that they get scaled, that we find the best, most effective ones and promote sustainability-linked finance, because it's going to be so much more impactful than some of the existing use of proceeds structures, in my opinion. Now, the other thing that I think is going to be transformational, not just for sustainable finance, but for finance more generally, is what I call spatial finance, which is the integration of geospatial data and analysis into financial theory and practice. And pretty much all of the risks, all of the externalities that are related to the environment, climate change, are in some way spatial. They depend on where you are on the planet. Context matters. You need to know where your assets are, and then you can measure their risk exposure. You can measure how they're going to affect the local and global environment as a result of that. Now, how do we do that? Well, we're going to need really good data, and we're going to need more of it. And part of that is going to be about Earth observation and satellite imagery in different spectral bands, processed using developments in AI, basically. And well, the amazing thing that's happened over the last decade is an explosion of new Earth observation platforms, many private, some public, that basically mean you can take high-resolution pictures of every point on planet Earth every single day and then process that information. And link that, if you can link that back to assets and who owns those assets, you can link that to securities, and then you can do some really powerful analysis, with a lot of this being automated using developments in AI and machine learning in particular. Now, this means unprecedented amounts of information, the ability to see what's going on in companies without them disclosing a jot. And the implications of this are really quite profound for trying to figure out what's going on in companies and in portfolios, and is a prerequisite for, I think, properly measuring climate and other environmental risks and externalities. And I'm very hopeful that change can happen quickly, because finance has a really strong track record of changing quickly. Norms, practices that are successful get copied across the world. Rapid innovation, mainstreaming is a feature of the financial system. And that's for a bunch of reasons. Low barriers to copying successful strategies, big incentives for copying successful strategies. And I think one of the things we all need to reflect on is, how do we use this natural tendency within finance to replicate, to mainstream, to change quickly, to make sure that finance and investment really does align with sustainability, and as a result helps to change the world for the better. So I'm going to stop there and looking forward to questions. Thank you.
네, 고맙습니다. 세계 최고의
Thank you very much, Professor Ben Caldecott, the global expert in green financing. And thank you very much for the insightful presentation.